Since Hamas initiated attacks on Israel a year ago, the oil market has expressed apprehension regarding the risk of an expanded conflict between Israel and Iran, the world's seventh largest crude producer. Until recently, both parties have managed to avoid direct confrontation. Despite ongoing tensions in Gaza and missile attacks by the Houthis in the Red Sea, the initial volatility in oil prices following the events of October 7, 2022 subsided, leading to a prolonged period of low and stable prices. However, last week, Iran launched approximately 200 missiles at Israel in response to Israeli actions against Hezbollah and its proxies. The global market is now anticipating Israel's rebuttal, raising concerns surrounding oil prices. Crude oil prices surged by 10% to $78 a barrel, marking the most significant weekly increase in nearly 2 years. Although oil prices corrected after October 7th, fluctuations have persisted. Previously, prices surpassed $100 a barrel following the Ukraine conflict in 2022. Could this situation be replicated? To evaluate the possibility of an escalation in oil prices, one must first examine Israel's potential retaliation strategies. Should Israel limit its attacks to military targets, such as missile launchers, and if Iran opts for a restrained response to ease tensions, the geopolitical ramifications on oil prices may be minimized. Conversely, should Israel escalate its actions by targeting Iran's civilian infrastructure, oil and gas facilities, or nuclear sites, a robust retaliation from Iran could ensue, initiating a cycle of conflict, with Tehran's oil sector, integral to its economy, becoming a primary target. This could reverberate through global markets, even absent a direct assault. In the case of an Israeli strike on Iranian oil facilities, potential targets include plants processing crude oil into refined products, such as the Abadan refinery, responsible for 13% of Iran's domestic gasoline supply. Data analytics firm Kepler suggests Iran could alleviate fuel shortages by increasing smuggling from Iraqi Kurdistan. However, domestic shortages would likely endure, and these attacks might inadvertently enhance Iran's exports of unrefined crude to international markets. Should Israel significantly disrupt Iran's energy exports, it may target the Kharg Island oil terminals in the Persian Gulf, which account for up to 90% of Iran's crude exports or other strategic oil fields. However, such actions could provoke backlash from allied nations. The Biden administration may be particularly apprehensive about potential increases in oil prices, especially with the US presidential election on the horizon. China, the largest importer of Iranian oil, would also express discontent. Notably, a Chinese firm currently manages the port of Haifa, Israel's premier seaport, and is a strategic investor in the Tel Aviv technology sector. Nevertheless, Israel may consider the associated risks acceptable and proceed with attacks on the oil ports. A successful operation could swiftly remove a substantial volume of oil from the global market. Last month, Iran reached a record export level of 2 million barrels per day, constituting nearly 2% of global supply. Even under such circumstances, the global impact could remain contained. Unlike the scenario following Russia's invasion of Ukraine, when demand rebounded post-pandemic and oil production peaked, current supply levels are robust while demand is expected to stagnate. OPEC Plus possesses over 5 million barrels per day of spare capacity, sufficient to offset any shortfall from Iranian crude, with Saudi Arabia and the United Arab Emirates holding more than 4 million barrels per day. The two countries have the potential to rapidly increase production. In light of recent market share losses, OPEC Plus members are strategically positioned to reverse earlier production cuts. Last week, they unveiled plans to increase output by 180,000 barrels per day each month for a year, commencing in December. The OPEC Plus alliance is experiencing a decline in internal consensus, as Iraq and Kazakhstan have consistently exceeded their quotas, creating additional pressure on other members, particularly Saudi Arabia, to expedite recovery. The Saudis, unwilling to cede further market share, have discarded their objective of elevating oil prices to $100 per barrel, a level essential for balancing their budgets and financing significant projects. Oil production is also rising in the United States, Canada, Guyana, Brazil, and several other countries. The International Energy Agency anticipates that non-OPEC production will rise by 1.5 million barrels per day next year, sufficiently meeting global demand. Oil demand is already waning due to sluggish economic growth in the United States, China, and Europe, coupled with a shift from gasoline vehicles to electric cars, particularly in China. Prior to the escalation of tensions in the Middle East, traders projected an oil surplus by 2025, potentially driving prices below $70 per barrel. Currently, crude inventories in OECD countries remain below their 5-year average. An attack on Kharg Island would likely disrupt the market, but oil prices are expected to rise by only $5 to $10 per barrel from current levels. Should Iran retaliate against Gulf states perceived as supporting Israel, the region could encounter further instability. Notably, relations between Iran and its neighbors have significantly improved in recent years, highlighted by the resumption of diplomatic ties with Saudi Arabia in 2023. Officials from Gulf Arab states have recently convened with Iranian representatives in Doha, Qatar, to emphasize their neutrality. However, with limited alternatives, Iran may target oil facilities in smaller Gulf nations such as Bahrain or Kuwait. Another potential scenario for Iran to instigate global disruption is through the blockade of the Strait of Hormuz, a vital waterway that facilitates the transport of 30% of the world's crude oil and 20% of its liquefied natural gas. Such a blockade would severely impact Iran's economy by disrupting oil and commodity exports while restricting imports of essential goods. This action could also provoke a strong reaction from China, which sources nearly half of its oil from the Gulf region. Although an Iranian blockade of the strait is a perilous endeavor, it remains a plausible option, particularly if new attacks or sanctions substantially diminish the country's oil exports. Forecasting market reactions to these developments poses challenges, especially as Iran's actions could provoke responses from Israel, the United States, and numerous other nations. The United States and China might deploy naval forces to address a blockade of the Strait of Hormuz. Should disruptions persist, leading to an oil shortage, crude prices could surge to levels that would trigger a collapse in demand. Experts anticipate that demand destruction may occur when oil prices reach $130 per barrel, which marked the peak in 2022. If the oil market perceives these scenarios as feasible, such concerns will likely be promptly reflected in current prices. Traders anticipating a price decline will need to swiftly recalibrate their investment strategies. Despite the recent increase in oil prices, this trend is not entirely unexpected, given the market's relative stability over the past 18 months. During the late trading session on Monday, oil prices exceeded $80 per barrel. Over the past year, prices have averaged approximately $82, while 2022 figures hovered around $100. The ongoing conflict in the Middle East has disrupted numerous prior forecasts, and for oil prices to breach the triple-digit threshold once more, several adverse factors must align. The ultimate outcome hinges not solely on supply and demand dynamics, but also on the degree of intervention by governments and international organizations in regulating the market to ensure a global energy balance.